silver prices hit $100 next year. I doubt silver is going to go even back down to 50. We should get $6,000 gold sometime in 2026. We're going to have a US dollar and a sovereign debt crisis. I think there will be sharp sell-offs to kind of get the day traders who are trying to be cute and just maybe come into the market with some leverage positions intraday. If we go into a major stock market meltdown where stock markets are down, 20, 30, 40, 50%, gold stocks could get dragged down. There are going to be a lot of people that are going to take profits too soon. They're going to say, oh, I've doubled my money or I've tripled my money. Let me get out.
I'm just wondering, when it comes to sentiment out there in the mainstream press surrounding gold and silver, what are you sensing? Is it still being scoffed and laughed at these levels?
They say, oh, let's take a look at the markets. Oh, the NASDAQ, and they talked about the NASDAQ. Let's look at Bitcoin. And that was it. They didn't even bother with the precious metals. Gold and silver, they don't have to talk about a rebound. We're at record highs. I think that there's a very reasonable probability that silver prices hit $100 next year. I don't know if it's going to be early or late in the year, but I think it's going to happen. And if it doesn't happen next year, it'll happen, the following year. But I think more likely next year. I mean, we have a lot of volatility, but once we broke above that $50 double top, I think that set a new floor for silver. I doubt silver is going to go even back down to 50. I think that we're headed significantly higher. We're trying to maybe find a new trading range in here before we have another leg up. But I think the catalyst for the recent move was not only the Fed rate cut, but basically what amounts to the return to quantitative easing. Even though the Fed's not admitting it, that's exactly what they're doing. And I think as the Fed is forced to expand that program and buy longer dated maturities, that's going to be an even bigger, more powerful headwind for both gold and silver.
Tailwind, I think you meant there.
Silver at $100 sounds dramatic, but the real story here isn't price. It's policy pressure quietly cornering the Fed. What's rarely said out loud is that balance sheet expansion doesn't need to be labeled QE to act like it. As Peter Schiff has argued for years, duration buying is stealth easing. Since 2020, silver has lagged gold by over 40% on a relative basis, a gap that historically closes late cycle. If rates fall while deficits explode, metals don't need hype, they need math. And this setup isn't about volatility traders, it's about currency credibility eroding in real time. What Peter Schiff says next reframes how investors should think about gold's upside beyond headline targets.
Last time I had you on the show, you said you thought gold could climb to $12,000 this cycle. We've come down slightly from all-time highs, but the setup continues to look extraordinarily bullish. How do you foresee gold performing ahead in 2026?
Well, it should be another strong year for gold. I think 5,000 is kind of a, minimal target. Maybe more likely, if you're looking for round numbers, we should get $6,000 gold sometime in 2026. That would obviously go along with $100 silver. I think both of those are reasonable targets. But ultimately, both metals are going a lot higher because I do think that we're going to have a US dollar and a sovereign debt crisis. And obviously, if that crisis hits next year, gold and silver prices can go a lot higher than that. But even if we manage to kick the can down the road throughout all of 2026, I think both metals could easily hit those targets.
Targets like $5,000 or $6,000 gold grab attention. But the uncomfortable driver is sovereign math that no longer works. US debt surpassed $35 trillion in 2024, while interest expense alone is now rivaling defense spending, a fact mainstream coverage glosses over. When experts talk about kicking the can, they're really admitting policymakers are trapped between inflation and default optics. Gold doesn't need a crisis headline to move. It responds to credibility loss over time, just like it did between 2001 and 2011. What's missing from the hype is timing risk. Crises arrive unevenly, but repricing happens fast once confidence cracks. For long-term investors, this isn't a trade. It's insurance against policy failure. And next, Peter Schiff addresses what happens when risk assets finally lose their footing.
Question that always comes up when it comes to a crash or potential large correction in the broad market is what will happen to gold and silver, the metals, and the mining stocks. Do you think that they will sell off dramatically in that instance as well? Do you think in such a scenario they'd recover faster than perhaps other asset classes? And would that be a buying opportunity in your view?
Well, I think any decline like the one we had an hour ago, is a great buying opportunity. I don't expect there to be that big a decline because I don't think the markets are going to make it that easy for people to buy because I think prices are still much too low. And I think at this point, you have a lot of investors who want to get into this market. And so there's too much buying beneath the market for the market to correct that substantially. I think there will be sharp sell-offs to kind of get the day traders who are trying to be cute and just maybe come into the market with some leverage positions intraday. I think, they still have to have risk there. It can't be just like one-sided, can't lose. So keeping the speculators honest, I think you're going to see plenty of sharp declines like we had today, but not major declines.
This is where optimism meets market structure, and structure usually wins in the short term. During liquidity stress events like March 2020, even gold sold off initially as margin calls forced liquidation. The key distinction he hints at is depth. There is far more institutional demand underneath metals now than there was 5 years ago. CFTC data shows commercial short positioning in silver has steadily declined, suggesting less downside fuel. Still, sharp shakeouts aren't bullish accidents. They're tools to flush leverage. Investors confusing volatility with trend risk getting shaken out right before the rebound. Next, Peter Schiff shifts from metals themselves to the company's leverage to them.
So I think you've really got to get into this market to the extent that we do see sell-offs. I expect them to bounce back very quickly. If we go into a major stock market meltdown where stock markets are down, 20, 30, 40, 50%, yeah, gold stocks could get dragged down, but I don't think they'll go down as much, and I think they'll come back much quicker. And a lot of it depends on what gold does. I mean, if we see a major drop in the stock market and we also see a drop in gold, okay, then the gold mining stocks are going to get hit. But if we see a surge in the price of gold, if the money that's leaving the stock market goes into the gold market instead of the treasury market, it'd be hard to imagine, gold moving up substantially and the gold stocks ignoring that and going down. You would think that they would rise as well.
Well, speaking of gold and silver miners, what a tremendous run they've had this year. The GDX ETF up around 140%, the SIL ETF up around 150% year to date. I think this ties into what you were just explaining, but for those who haven't entered the sector at this point, would you be waiting for a dip, for a pullback here, or do you think the greater risk is the mining stocks continue to soar and leave those waiting to buy the dip in the dust?
140% run in GDX should make any disciplined investor pause, but not for the reasons TV pundits suggest. Miners are still historically cheap relative to gold prices, with many trading below 8x forward cash flow, despite record margins. The hidden risk isn't valuation, it's execution, cost inflation, and political exposure. If capital fleeing equities bypasses treasuries, miners become operating leverage to monetary stress, not just gold prices. But chasing without risk management is how gains evaporate. This is where position sizing matters more than conviction. And next, Peter Schiff talks about the hardest part, knowing when patience beats action.
Yeah, I mean, I think the bigger risk is missing out on the rest of this bull market, which is going to last for quite some time. So yeah, I mean, and I also think that the risk is going to be that there are going to be a lot of people that are going to take profits too soon. They're going to say, oh, I've doubled my money or I've tripled my money. Let me get out. And, look, selling some, taking some of your profits off the table, I suppose I can't necessarily argue with that as a risk management strategy. But I think that we have a long way to go. And so I think that, people that think, okay, it's time to cash out and look for something else, I think that that's going to be the mistake that people make, thinking that it's a top, thinking that, they've made enough money and they want to get out. Because I think we're starting from such a low level, even if, stocks double or triple, you got to look at where they moved from, and where they, how low they actually were, relative to, past, and where they're likely to go, because I think earnings are going to explode for these companies.
The quiet risk here isn't greed, it's premature relief disguised as discipline. Historically, mining equities have delivered their largest gains in the final third of precious metals bull cycles, not the opening act. As Peter Schiff often notes, most investors sell winners emotionally, not analytically. Many miners are still priced as if gold were $1,800, while spot prices sit far higher, leaving earnings leverage underappreciated. Locking in profits feels safe, but exiting before earnings expansion shows up in financial statements can permanently cap returns. Next, Peter Schiff shifts from valuation blindness to media silence, and why that matters more than price.
And so I think the valuations, are way too low, that the market is not factoring in and crediting these companies for what they're likely to earn in the future, not just from today's gold prices and silver prices, but from the gold and silver prices that we're going to have in the future.
You're probably one of the people in the gold and silver space who does the most media appearances and the most high-profile media appearances, appearing on Fox multiple times, and throughout your career, obviously, you've made many media appearances. I'm just wondering, when it comes to sentiment out there in the mainstream press surrounding gold and silver, what are you sensing? Is it still being scoffed and laughed at these levels? Is it being kind of belatedly accepted? Are people getting enthusiastic about it? And what do you think it will take for the talking heads on CNBC, etc., Jim Cramers of this world, to really start pumping up gold and silver? And is that a point where you'd look at, hey, maybe it's time to take some profits and get out here?
Well, I mean, I don't know. I mean, they barely even report on it, let alone pump it.
When mainstream media ignores an asset class, it's rarely accidental. It's usually unprofitable for someone. Gold miners trading at single-digit forward multiples don't fit a narrative driven by ad dollars and trading volume. CNBC enthusiasm historically peaks near tops, not during accumulation phases, as seen in tech in 2000 or crypto in 2021. As Peter Schiff has pointed out, silence is often more bullish than praise. Investors should worry less about media validation and more about whether future cash flows are being discounted at all. Next, Peter Schiff exposes how selective coverage shapes what investors believe is relevant.
Even today, I was watching CNBC this morning, and this is when gold is up like $60, silver's, still at record territory, up above 54.30 or something, or 64.30. And as they're going into a break, they say, "Oh, let's take a look at the markets. Oh, the NASDAQ," and they talked about the NASDAQ. "Let's look at Bitcoin." And that was it. They didn't even bother with the precious metals. And in fact, I was watching yesterday, and they said, coming up, we're going to talk about Bitcoin and whether or not we're going to see a rebound next year. But they hadn't even mentioned gold or silver yet, because I was waiting for that. And gold and silver, they don't have to talk about a rebound. We're at record highs. So they're not even barely reporting on it. Yeah, once in a while they do mention a gold or silver stock, but they don't really encourage anybody to buy into it. They just kind of mention that it's gone up. They're still trying to, direct their audience to Bitcoin. So I think before CNBC even remotely starts to advocate for gold or silver, or have guests like me that come on, I never come on that network, but if they have people that are real, gold people, it's probably not going to be till after all the air comes out of the crypto bubble.
This is a classic market mirage, record prices paired with total media indifference. Gold moving $60 in a day is statistically rare, yet it barely registers in headline rotation. Media focus follows liquidity and sponsorship, not macro significance, which is why Bitcoin gets airtime even when underperforming. Historically, gold coverage explodes only after sustained multi-year gains, long after smart capital has positioned. For investors, this absence of hype suggests the trade is early, not crowded, and next, the argument turns uncomfortable, questioning whether crypto's narrative still holds.
And the crypto community no longer can afford to advertise on CNBC. because right now they're trying to pander to their advertisers, and I think the crypto advertisers don't want anybody focusing attention on gold because they're trying to get people to buy Bitcoin instead of gold. And I think this is what's happening right now, and gold should be very problematic to the Bitcoin pumpers, because why isn't Bitcoin going up if it's digital gold and if it's supposed to be better than gold? If gold is going way up, then Bitcoin should be going up even more. But instead, it's down as gold's going up. So they got no explanation for this other than, well, gold moves first and Bitcoin moves second. Well, who says? And why? I mean, why wouldn't it already be moving? If Bitcoin is going to move on the rate cuts and the return to QE, why isn't it moving now? Right? I mean, it doesn't make any sense that it just waits for gold to stop going up and then Bitcoin all of a sudden magically starts going up. It doesn't make any sense that that would happen. Maybe that happened a few times in the past, but that might be more of a coincidence than anything else. I don't think it's a foregone conclusion that every time gold goes up, Bitcoin must go up later and must go up more. I think it could just come crashing down. In fact, the fact that it's not rallying is a good sign that it's about to go way down.
The data disconnect here is glaring. Gold is responding to monetary stress while Bitcoin is not. During prior easing cycles, correlated assets move together. Divergence signals narrative risk. Bitcoin's failure to confirm gold's breakout raises questions about its role as a hedge versus a liquidity trade. As analysts like Peter Schiff have noted, assets tied to speculative liquidity struggle when real rates and confidence collide. If Bitcoin can't rise during an easing narrative, its downside during tightening or risk-off events becomes harder to ignore. Next, Peter Schiff's focus turns to what survives when narratives finally meet balance sheets.
Also, if you don't own any physical precious metals yet, hey, we got a pullback going on. Gold's actually back to positive on the day, but silver is still down. So, buy it. I don't think it's going back to 50. So if you buy it at 61, that's not that bad. If I'm right, it's going to 100 next year. And that's not going to be the top. So you can buy some physical gold and silver at Schiff Gold. I'm also encouraging people to sign up for an account at tgold.com. Right now, that's a page on the Schiff Gold website. But if you go to tgold.com, you can buy some gold or silver. We'll store it for you. Ultimately, that gold and silver is going to get tokenized if you want that. And we'll have the option to take delivery either in physical form or in a token through a blockchain. So, I'll have my own token. I believe that tokenized gold is probably the only thing that may be viable when it comes to blockchain. We'll see. But I don't think, fiat tokens like Bitcoin are going to have any lasting value. But so you can go there.
When an asset fails to rally during its supposed perfect narrative, markets are quietly signaling a credibility problem. Bitcoin lagging while gold stabilizes mirrors past risk-off shifts, including late 2021 when liquidity tightened and speculative assets cracked first. As Peter Schiff has argued, assets without intrinsic settlement value depend entirely on confidence staying intact. World Gold Council data shows physical gold demand rising even during pullbacks, suggesting real accumulation, not momentum chasing. Tokenization sounds modern, but it only works when anchored to tangible reserves, not faith-based scarcity.